Hi, everyone. How are you? I hope that you are well. So, today we're going to talk about the stock market, but this is for beginners. So, this is for people who are not currently in the stock market, or perhaps you just started getting into the stock market, or you are on the fence on whether you should be on the stock market or not. So, first, we're going to start off with the definition of a stock. What is a stock? So, a stock is actually a business. So, one example of that is McDonald's. So, you could buy a share of McDonald's, and what you're doing is you're buying a piece of the company. So, when you buy stocks, you are buying a piece of the company. You have a percentage of equity in this business, and that is why the other name for stocks is called equities. If you hear the word equities, stocks is synonymous with equities. You are buying a percentage of equity of a business. So that is the definition of a stock. What happens is the company, they need money to run their business, and 9 times out of 10, they aren't going to use their own money. They're going to get money from other people. Hence, they do what is called an IPO, or initial public offering. That means they open it up to the public, and you give them a portion of your money by buying a share of stock. That is how they get money, and you make money because when they get profit, you get a portion of that profit. You're a part owner of that business. So that is what a stock is, and that's what happens when you buy into stocks. One example, like I said, is McDonald's. If you were to choose to buy a share of McDonald's. And so, how do stocks make money? Stocks make money in two different ways, either through capital gains or through dividends. And so, what capital gains is, say you buy it low and you sell it high, and that profit is the gain that you made. Hence, it's called capital gains, or the other word is profit. The other way that stock makes money is through dividends. And so, what happens is when the company makes money, they give off a part of that money to people who are invested in the company, and it's called dividends. So, you'll see the actual dividends in your account. Most of the times, it's on a quarterly basis, and the dividends are kind of small, but you will notice them. So this is money that you are making simply by being invested in the company, and it's called dividends. So there are different kinds of stocks. One stock being called the blue chip stock, and the other is the growth stock. So the blue chip stocks, they have been around for a very long time. They are established companies, and they offer dividends. So, examples of the blue chip stocks are Amazon, Apple, Coca Cola. Those are just some examples of the blue chip stocks. Then on the other side, you have the growth stocks. And so the growth stocks, they grow at a faster rate than other stocks that are in the market. However, the growth stocks do not pay dividends. And so that is the example. That is the difference between the blue chip stocks and the growth stocks. An example of the growth stocks are Moderna and Zillow Group, which is the platform for the real estate. Those are two examples of the growth stocks. Now, as far as getting into the stock market, diversification is the recommendation, and the recommendation is usually index funds and ETFs. There are a variety of things that you could get into. If you were to get into individual stocks is more riskier because if you were to put all of your money into an individual stock and that business would fail, then you would lose all of your money. So that is why some people choose not to invest in individual stocks. However, on the other side of that, people who do take the risk of investing in individual stocks, some see their portfolio soar. And examples of that are people who invested in Amazon. When back in the day, Amazon was just considered a speculative. You know how Bitcoin is looked at as a speculative asset right now? Nobody really knows what Bitcoin is going to do. Well, that is the same thing that was happening with Amazon. Amazon was considered speculative. However, the people who got in on Amazon at that time and invested money in Amazon, they saw their portfolio skyrocket when Amazon became a hugely successful business. And by skyrocketing, I mean making like $200,000 off of $1,000 investment. Things like that happen with individual stocks where you could either soar or if the business fails, you could lose your money. So when it comes to individual stocks, only put in what are willing to lose. But because individual stocks are riskier, I would not stay away from them completely because of what I just told you about Amazon. So only put in what you're willing to lose when it comes to individual stocks. However, when it comes to index funds and ETFs, those are diversified. So it offers you a safety net in the index funds and the ETFs. If a business were to fail, they monitor those very closely and they kick them out and they replace them with successful businesses. So when it comes to index funds, what is an index fund? So an index fund is a collection of stocks and it tracks the index. And an example of an index fund is the S&P 500. So the ETFs, what is the ETF? ETF is it's exchange traded funds and it's also a bundle of stocks. Examples of ETFs would be the different sectors you could go into. For example, the tech sector would be one example. So, this is the stock market in a nutshell for beginners. Now, I will be offering an investing course in about a month or two where I delve in deeper into the stock market, talk about things like compound interest, and show you actual calculations. If you start from this point, in how many years will you be at this result? Things like that. Compound interest, showing you how your money grows, uh, more definitions of the stock market, what the stock market is, and what to actually invest in. So keep in mind, I'm not a financial advisor. I don't give financial advices for educational and informational purposes only. However, investing is very important when it comes to building your wealth. So the stock market is definitely something that you want to be in if you're not already in. So educate yourself about the stock market. And if you're interested in my course that will be coming up, you can sign up to the link below and just leave your email address and let me know if you are interested. So, this is the Love and Money Show. If you like the show, please hit like. What it does is it pushes the channel out to other people so that other people can see the channel. If you're not a subscriber, please hit the subscribe button and the notification bell next to it and leave your thoughts in the comments. Thank you for listening and have a great rest of your day.